In the last video in this series, I stressed the importance of saving heavily and not obsessing about getting super high returns. Sure, super high returns are nice, but the expectation of super high returns can lead to a lower savings rate and thus disappointment if those super high returns don't materialize. Today I'm going to focus on the importance of avoiding punishing mistakes. You'll recall from part 1 this slide, which shows years to financial independence as a function of savings rate and realized rate of return in phase 1. One example I gave was a person who saved 10% of their take-home pay in an investment, and the hoped-for rate of return was 8% after adjusting for price inflation. Unfortunately, the investment resulted in a 2% per year loss after inflation because of a bad event that happened shortly prior to the person changing their asset mix to something less risky. This ended up adding 24 years to the person's working career. Of course, this is just a hypothetical case. I just used it to show what could happen. It seems difficult to believe, but I will show you how this can happen. It won't happen to every investor every time a person swings for the fences. So one can argue, how important is this really? However, if it happens to you, I can guarantee that it will be of great importance to you. Let's take a look at one of America's favorite juggernauts, General Electric. Many of you probably don't remember, but in the 1990s, GE was one of the must-have stocks in everyone's portfolio. They were a giant conglomerate headed by legendary Jack Welch. Yes, that's the same Jack Welch who inspired countless books to be written, such as The GE Way. Some even said that you couldn't go wrong just putting everything in GE stock. GE was known back then as a one-decision stock. You just bought it and let Jack Welch turn you into a millionaire. On this chart are 3 traces starting in 1990. The blue trace represents how much a person would have in nominal capital gains for every dollar invested in 1990 as time went on. So by August of the year 2000, a person who bought GE stock in 1990 would have multiplied their wealth by 11.3 times. Of course, capital gains aren't the whole story. We have to include dividends into this picture. GE was a big dividend payer. The red trace is the wealth multiplier for each dollar invested in 1990 if all of the dividends were reinvested. To make things simple, I'm assuming that the dividends were not taxed. When the impact of dividends are considered, each dollar invested in 1990 by August of the year 2000 turned into $108. Of course, a dollar in 2000 was not worth the same as a dollar in 1990, so we need to adjust by the Consumer Price Index. The other trace on this plot is the CPI-adjusted total return that the investor would have for each dollar invested in 1990. So really, the investor would have multiplied each dollar by a real multiplier of about 80 times by August of 2000. Not bad. If we assume that our investor didn't just buy in the year 1990 and then sit and wait, but instead bought $1,000 worth of GE stock each month between January 1990 and August of 2000, it works out that the internal real rate of return would have been about 50% annually. Can you imagine? A person who swung for the fences with GE stock was feeling pretty good about their investment prowess by the turn of the century. But then the fortunes of GE as a company started to change. It suffered through the bear market of the early 2000s. Many held it because, after all, it was GE. And given that it was a bargain and priced at bargain prices, they probably continued to buy additional shares. It rebounded into the financial crisis of 2008 when it went into another serious decline. Again, people held it because, after all, it was GE. And again, many people probably kept buying more shares because dollar cost averaging lowers risk since you're buying more shares at lower prices. For a while, their actions worked out well as the price of GE rallied. Then in 2016, a funny thing happened. GE started cutting dividends, and their price fell relative to the market. The last of the remaining original Dow stocks was removed from the venerable Dow. Those who had made a regular monthly CPI adjusted investment into GE stock, after 30 years of discipline, ended up with a rate of return of just 0.6% per year on a CPI adjusted basis. And this does not even take into account the taxes that they would need to pay on the dividends along the way or on the capital gain. But belang P, I hear people say, the CPI adjusted wealth multiplier is about 10 times at the end of this 30-year period. That's a real rate of return of about 8% over the 30 years. That's a great return. How do you get 0.6%? That's a great question. Remember I said that new money was being invested each and every month. If the person had bought in 1990 and never put another dollar into the stock, then they would have realized a rate of return of 8% per year. But then each dollar that was invested since that time was invested at a higher price level and thus would generate a lower return. Many of those dollars generated a deep loss. So the end result of monthly purchases over 30 years was a paltry 0.6%. A high-interest savings account would have been a better investment. But the point here is that by swinging for the fences, many investors ended up with very disappointing results. The worst part about it is that while they were realizing poor performance, they were also depleting one of their most precious possessions: time. And this is the most important reason not to make big mistakes, especially late in your investment career. Late in life is usually when the cost of mistakes is the highest. That's when you have the most to lose and the least amount of time to make up for it. I can guarantee, based upon some of the comments that I have seen over the years, that there are people out there who have a very high degree of confidence in their investment choices, whether it be Bitcoin, Tesla stock, silver, or whatever else they are betting heavily on. I totally get it. It's easy to develop a high level of confidence in something that you study heavily. All I can say to these people is, just don't forget all of the people who are buried in the graveyard of investors who went before you. Many of them have stories to tell about their one-decision investments from decades past. In the last video in this